With the end of patience, then what? Hello again, it's Martin North from Digital Finance Analytics. I just post covering finance and problem news with a distinctively Australian flavour. Well, there's been a lot of commentary on the Reserve Bank's comments on Tuesday after the meeting decided not to change the cash rate, but did signal a change in sentiment. And in fact, Westpac did quite a good piece summing up where things are. They said the Reserve Bank governor surprised Westpac on Tuesday with the board's decision to abandon its patient approach to monetary policy. Since the last board meeting, when patience was emphasised, we have seen a further drop in the unemployment rate from 4.2% to 4% and a continuing surge in job vacancies, pointing to further falls in the unemployment rate through the rest of 2022. So we have revised down our forecast for the unemployment rate, which is now expected to reach 3.25% by the year's end compared to 3.75% previously forecast. That's much tighter a labour market. That much tighter labour market in turn points to a stronger lift in wages growth in 2023, with a peak of 4% now expected compared with our previous peak of 3.5%, he said. We've also recently revised up our forecast for the US federal funds rate, which is now expected to peak at 2.375% by the end of 2022. And he went on to say, we expect the RBA has also been raising its own expectations for the federal funds rate in the wake of recent data releases and the strong rhetoric from FOMC members, including Chair Powell. And recall that the shift by the RBA board from a patient to a more proactive approach to monetary policy is in the context of an election campaign that will be fought through most of April and the first half of May. By establishing a clear expectation that the board will now begin the tightening cycle in June, the RBA is willing to risk political controversy, particularly around any potential discussion of the role of the federal budget in changing the board's stance. Being aware of such complications but still being prepared to change the stance emphasises the board's determination to change the policy message. I will mention that it's pouring like you would not believe at the moment. Here's a video I took a little earlier just showing how much rain is coming down, and there are flood warnings for Sydney and the surrounding areas. We are in for a wet few days, so you may well hear some background noise as I make this recording. Before the decision to abandon patience, Westpac had expected the initial rate hike in the cycle to come in August. That forecast was made back in January the 20th, when most published analysts were still expecting the cycle to begin in 2023 or November 22 at the earliest. That January 20 shift was Westpac's first forecast change since June 2021. Our profile at that time was for rates to peak in February 2024 at a cash rate of 1.75%, with 2 rate hikes in 2022, reaching 0.5% by the year end, later tweaked to 3 moves to 0.75% by the end of 2022, with the same terminal rate of 1.75% coming by the end of 2023. But now, he says, we expect a much shorter tightening cycle with consecutive rate hikes in June at 15 basis points, July 25 basis points, and August 25 basis points. That point would see the 2020 COVID emergency cuts unwound, with the board likely to take a pause in September. Further hikes are now expected in October at 25 basis points and November at 25 basis points, reaching 1.25% by the year's end. The cycle would resume in February 2023, with 3 more 25 basis point hikes in February, May and June 2023. The 3 hikes in 2023 will be in the context of accelerating wages pressure, with the annual rate reaching 4% by mid-2023. And he said readers will be aware that we expect the peak in the federal funds rate by December 2022 of 2.375%. We now see the peak in the RBA cash rate at 2%, up from 1.75% around 6 months later. And he said we'd be surprised if the peak in the RBA cash cycle was too far out of synchronisation with the FOMC. Our previous profile of 2022 had hikes in August, October and December in 2022, but the changed labour market situation and what looks like to be a more urgent approach from the board signals an earlier beginning to the cycle and only one break in the sequence to mark the unwinding of emergency cuts. The expected tempo is in line with the latest tightening cycle over a decade ago in 2009-10, that came in two initial sequences of consecutive moves over 3 months, October, November, December in 2009, and March, April, May in 2010. The rationale at the time was to take back the GFC-related emergency cuts in anticipation of the inflation and wage pressures that were building during the second round of the mining boom. Then wages growth ultimately lifted to just below 4%. A similar initial sequence of hikes in 2022 reflects the new urgency from the boards to unwind the emergency cuts during COVID and lift rates back to levels that are more reflective of the recovering economy. The further tightening in 2023 will be more about the backdrop of a record low unemployment rate, accelerating wages growth, and sticky inflation as businesses continue to pass on lagged cost increases resulting from supply shocks. While we've accelerated the pace of rate hikes in 2022, with a peak of 1.25% by year's end, we've only lifted the expected terminal rate from 1.75% to 2%. This 2% will nevertheless result in a significantly higher debt servicing ratio for the household sector than in a 2009-10 tightening cycle. That said, we're mindful of the $250 billion in excess savings being held by the household sector and around $170 billion for businesses, which has been accumulated through COVID when policy supports to income combined with pandemic-related restrictions on spending. The federal government alone allocated around $330 billion to supporting the economy through COVID, so there's been a massive transfer from the government balance sheet to the balance sheet of households and businesses. Much of this excess saving will be on the balance sheet of high-income, low-debt households, but is also sitting with low-income, high-debt households that will be acting as a potential buffer to higher rates. Banks report that borrowers are on average 2 years ahead on their mortgage repayments, while there has been a $100 billion surge since COVID in balances in redraw facilities. Without those buffers, the peak cash rate would be lower, and there is a clear upside risk to the terminal cash rate if these buffers prove to be more substantial. The RBA will also be mindful of the risks of over-tightening into the buffers that eventually are working through exposing households to damagingly high mortgage rates. But there will still be considerable sensitivity to the higher rates. Consider, for example, the wave of fixed-rate borrowers that took out 2% loans during the pandemic. This group is set to roll onto mortgage rates more than double their original rate over the course of 2023 and 2024. Under Westpac's scenario, the standard discounted variable rate for owner-occupiers will be around 5.5% by mid-2023. Signals for the RBA that the tightening cycle has peaked will include a significant slowdown in consumer spending, falling household prices, and a stabilising unemployment rate aided by a lift in immigration back towards pre-COVID levels. Through 2023, inflation is to move back to the upper end of the 2 to 3% target band as commodity prices and supply constraints ease globally. With these changes in the cash rate profile and the volatile markets, there will be some changes to our profile for fixed rates, both swaps and bonds. They'll detail that, and they're going to detail that later. But the important target for the 3-year swap rate will be around 2.5% in the second half of 2023. That's up from 2.25% as markets accept an outlook for a steady terminal cash rate of 2% through 24 and 2025. And they also retain their view that the spread between the Aussie dollar and the US dollar long bond rates will narrow significantly over 2023 as the federal fund rate settles above the cash rate. Reflecting the higher Aussie dollar terminal cash rate, they've also lifted their 10-year bond rate by the end of 2023 from 2.10 to 2.20, and the spread lifting from 0 to 10 basis points. Those relativities reflect the Australian economy's greater sensitivity to the short end of the yield curve and the potential upward pressure on the long bond rate as the Federal Reserve embraces its quantitative tightening policy. So there is a very significant message here, and that is that rates are going higher, mortgage rates are going higher, and people will have to pay more. Now, some do have buffers, I agree, but those buffers are not equally spread, and we know that there are significant numbers of households that are already close to the edge, more than 41% from our modelling. Therefore, as rates rise, this is going to have a significant impact both on household finances and confidence and also on the housing market. Now, one interesting question to my mind is, if home prices do begin to slide, will that slow the RBA's moves up? Or will they be trapped because the Fed is moving fast and hard. And as Westpac says, the truth is that the Reserve Bank is not going to get very far out of kilter compared with the Fed. So in a way, to understand what's going to happen here to interest rates, don't look at what the RBA says, look at what the Fed does. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.